Okay, the big IPO that starts today is Metropolis Healthcare. It's a 1,200 crore issue that is there. But remember, it's an offer for sale in which the promoters and an investor is looking to exit. So funds will not come into the company at this point of time. The pricing detail is 877 to 880 per share. But we all know that. But we want to get in more details what this business is, what's going to happen with Ameera Shah. She is the MD of Metropolis Healthcare. Thank you so much, Ameera, for joining us.
My pleasure.
First of all, the basic, it's an OFS. It's not, money is not going to come into the company. Is the company sufficiently funded, at least to cater to the working capital needs, other needs, at least in the near term?
No, absolutely. I think the company, in fact, the free cash conversion from EBITDA is almost 50%.
Okay.
So cash flow is really not an issue. It's a very sustainable business. A lot of internal accruals gets accrued. And we not only manage our working capital, but we also manage our growth expansion through our internal accruals. In fact, in the past, we've done lots of acquisitions as well through our internal accruals. So primary capital is therefore not needed at this point of time. Of course, if we tomorrow go and do some large deal, then we would use the balance sheet to leverage some debt, which today we are debt-free. Yeah. We also have the opportunity to raise more capital on the public markets or use stock as currency as well.
Okay. The big concern, at least for diagnostic space, be it, and we've spoken to multiple players, is this unorganized market. How important is that? Are you growing in this organized market? Because somehow the things that we speak to people, and this thing is that unorganized still controls a large chunk, and the shift that everyone hoped will happen from the unorganized to the organized market has not yet happened.
I mean, frankly, that's the opportunity, to be honest with you. Today, almost 85 to 90% of the market is unorganized, which used to be 100% at one point of time. So even that we've seen this change of almost 15% of industry move to organized is really an effort on the parts of few players like us who've tried to organize the industry and move it forward. I believe that going forward, this will continue to happen probably at a faster pace if there are 2 or 3 structural reforms that happen in the industry. Number one is that if there are some minimum standards put and some governance put in terms of quality, because today the biggest issue is, I'm not sure if you're aware, but there is no minimum standard required for pathology, which means anybody can operate a pathology lab.
Okay.
You don't need a pathologist, you don't need equipment, you don't need space, you don't even need to do the test.
Okay.
So in fact, there was a sting operation done by media itself where they went and they found some lab who was claiming to give 1,500 reports a day to patients, was never doing the test at all. So in light of this, quality players like us who follow global quality norms have really risen as a respectable, trustworthy brand, where people know that what we say is what we do. And therefore, that's what is also organizing the unorganized market. The second is insurance. Today, if you see, people are actually paying out of pocket. People pay cash. Unless they are hospitalized, health insurance doesn't cover it.
Okay.
When you go to a doctor, when you come for a blood test, you are paying out of your own wallet. As health insurance covers this, what we have seen globally, that the diagnostics volumes jump. And specifically, the specialized test volumes jump. Because today, doctors are actually very careful in the number of tests that they prescribe. In India, one patient, usually we do 2 to 3 tests. In developed markets, it's one patient is 10 to 12 tests.
Okay.
And that's how adequately diagnosed they are. So we will actually see when health insurance covers diagnostics, this will structurally change the industry as well, along with government regulation. But we're obviously not waiting for these things to happen. Metropolis is following a 3-pronged strategy. One is the organic growth strategy, where we're going closer to patients and moving it from the unorganized to the organized, and getting doctors to refer to our brand, which is a brand-led strategy. The second is acquisitions, where we go into new markets and we acquire the unorganized sector and bring them under our umbrella. And the third is we've come up with some very innovative business models that again find a way to bring the unorganized sector under our brand umbrella, but not through capital infusion of acquisitions, but through other kinds of contracts which are more asset light. So we're following a 3-pronged strategy, which is why actually our growth is faster than not only industry today, but also our competitors.
B2C is one segment in which gets you the majority of your revenue, and you're looking to actually grow that. But the thing is that there is enough competition here. The amount of promotions that you get it in your emails, you got your SMSs, you see billboards across this thing. Is that not a concern that the growth will probably not be as robust, or the volume growth won't come in, and you probably won't have the pricing power, to go ahead with this model? What's your say on this?
See, I want you to think back to yourself. yourself. I mean, if tomorrow you or somebody in your family wanted to get a test done, let's say for cancer or something significant, would you go by what promotion you see on a billboard? Would you go by what advertising you see in a newspaper? Or would you say that, look, let me go to my doctor and let me go to a trustworthy lab which really helps me figure out what is going on in my body? See, you have to remember, people only go to a diagnostic lab once or twice a year, and the average spend is 600-700 rupees. Pricing is not the issue, because people are saying, when I'm sick, I want to genuinely know what's happening in my body. I'm not interested in who gives me 50 rupees discount and 100 rupees discount, because if your diagnosis is wrong, your treatment will be wrong. Right? And 70% of treatment decisions require correct diagnosis. So what we have actually seen is that when you're doing a brand strategy, which is consumer-led, and see, a brand only gets built is if you have earned that trust from consumers. And we have spent more than 38 years in earning that trust from doctors and consumers who rely on Metropolis reports for their treatment. So it's very difficult for a new entrant or an existing entrant to come, just simply advertise and earn that trust overnight, unless they have delivered that year by year, experience by experience.
So you're saying that you haven't cut your prices. Prices
Absolutely.
Are going high. What's the pricing trend? Let's take an average test or a bundle of tests. Is the pricing trend moving higher? Is it stable? Is it moving lower?
See, as a brand, we have the ability to increase prices. So we have been doing a very marginal price increase of maybe 2% in the last few years. But that's not because we don't have the ability to increase prices. That's because we are in healthcare and we want to make sure that we are not making things unaffordable for patients. We are in a social sector also, where you have to balance at the end of the day what is good for citizens of the country along with commercial interests. So our strategy actually is not a increase prices every year drastically and take from patients. Our strategy is increase volumes, do very small price increases, maybe every couple of years, but do a test product mix strategy, which basically means that today, if let's say somebody is diagnosing heart disease with a cholesterol, there are today far better diagnostic tools and tests available to diagnose the same heart disease, which is good for the patient and better for the doctor to make a treatment decision. So Metropolis educates the doctors that, look, these are the tests which are available. Why don't you start using more effective diagnosis tools? And we move the patient up the value chain. As we move the patient up the value chain, actually the realization for Metropolis also for patient is better, and the patient gets a better diagnosis. So it's a win-win for both.
So basically, you're very strong in West and South India. And basically, we've seen that when the incumbents have the power to raise prices, and that's what you said right now, but you're focused on two areas. Now, if you're looking to go and expand in other areas, you probably won't have the pricing power. Let's say you go to North, you won't have the pricing power to do it. You will have to play the pricing game there.
Yes and no. Today we are across 173 cities across India in 19 states. While we are leaders in West and South of India, it doesn't mean we're not present in North and East. So in fact, we've got lots of labs and collection centers all over North and East. Surprisingly, today Delhi and Calcutta are probably our fastest growing markets in the country. The key thing is what strategy you employ when you go to these new cities. While in the West and South, in these key markets, we are actually focusing on a B2C-led strategy. In North and East, we are not going right now with a B2C-led strategy. In some pockets, we are. So in some pockets of certain states, we are going B2C, but in some pockets, we are doing B2B. Now, what's important to realize is that our B2B is a very differentiated B2B, where we are focusing more on specialized tests, where pricing is not that big of a concern. Because like I gave you an example, people are not looking for a 50 rupees discount when they're talking about a cancer test. They're looking for a correct result. So we are focusing more on specialized tests where pricing is not that much of a focus. And our B2B means also our medical representatives are actually going and meeting doctors, educating them. So therefore, our brand actually reaches most patients even through B2B.
Would you generate volumes on this? Because what we've seen and spoken to other people, pricing for, if you're looking to play the volumes game, you need to go on the pricing front. Is that a strategy that you would stay away from? Would you not focus on this?
I fully agree with you that if you are looking at a volume-led growth, then you do have to succumb somewhere on the pricing, which is why our strategy is not a volume-led growth. It is a mix of good volume increase, product mix change, as well as a small pricing increase every year. And really, we believe this is what is going to build a sustainable, profitable business, continuing to build a sustainable, profitable business as we expect.
I want your comments on, there's a brokerage called Haitong, which came out with a dealer survey, and they went across diagnostic survey, they went across the countries and did a test and all. And their finding is that, they're saying that the market has become very challenging for pathology and diagnostic players, and the competition is being very, very intense. And the pricing power won't stay. Is that something something that you are at the grassroots level seeing, that competition is becoming intense and probably the market is becoming extremely challenging to work with?
See, I think we have to first segment the market. I think it's very important not to talk about pathology as one big shape, right? Let's segment it. So let's talk about first the B2C side. As I mentioned to you on the B2C side, that trust and credibility doesn't get earned by everybody. And therefore pricing does not become a pressure. If you forget us, you take any laboratory chain or even individual laboratory, you will not find their prices going down on B2C. You will actually find their prices stable or maybe a slight increase every year, which is in line with, not even in line with inflation. So I don't think pricing in the B2C segment is a huge concern at this point of time for everybody in the industry. The second part of it is B2B. Now in B2B, there are two pieces. One is what we call the semi-specialized industry and one is what you call the specialized and super specialized industry. Here I'm talking about the kind of tests. If you see in the semi-specialized tests, there are many players who have come into the industry in the last few years. When I say many, there are maybe 5 or 6. It's not some 30, 40, but there are 5 or 6, some of them funded by PE, some of them funded by corporates who've come into the industry and have gotten into the semi-specialized space. So the competition you're talking about is a little bit higher in that space. These are tend to be mostly automated tests where there is not so much of manual intervention or scientific expertise required, and therefore people are competing on price. This is not our focus area. The second bucket is the specialized and semi-specialized bucket, which is where again you're generating samples for very specialized disorders and specialized testing, which 99.9% of the market doesn't have the capability to do. No labs actually have the capability, very few labs have a capability to do this kind of testing. So in that area, there are only 3 or 4 of us who are actually competing with each other. And pricing pressure is not the biggest thing driving the business. There is actually credibility.
Okay. A couple of things. I know you can't give forward-looking statements, but something that is already reported, margins have corrected for you from 30% in FY16. It's moved to levels of 25% EBITDA margins as per your RHP, and now close to 26-27%. What's the reason why the margins have actually come off a little bit?
Actually, it was not 30% in 2016. We've had very stable margins the last 3 years.
Okay.
Our EBITDA margins have been between around 27% the last 3 years. Our PAT margins have been stable at 17% the last 16 to 17% the last 3 years. We have not seen any correction or EBITDA margin suppression at all.
Okay.
In fact, even currently, we are very comfortable at the growth rate we have of 18% plus in 18-19 for the first 9 months. And even though the profit margin EBITDA margin is showing at about 25 to 26% for the first 9 months. I'm not able to give forward-looking numbers, but we believe our margins will be consistent even over the next.
Well, you've continued to grow on a CAGR on the revenue in double-digit, high double-digit, 15 to 17 or probably 20%. The growth on the profit front is single-digit. That is something that we've seen. Is that something? Why is that happening?
The growth in profit has not been single-digit. It has been in line with revenue, which is why the PAT margin has been stable at about 16 to 17%. There was 1 year in which you will see a single-digit PAT margin, but that's because the year before there was a 27% increase in PAT. Now that was not because of the operational core of the business. It was because of an extraordinary income that we earned in 1 year, which was a sale of our South Africa business, which is why the next year is looking a lower PAT, but that was not from the ordinary operations. It was an extraordinary income which fluctuated the base.
Was this the other income? Because I'm seeing it moved from 15 crores in FY16 to 23 to 8 to 7 in this thing. So is that what you're referring to?
No, I'm talking about that. What you're talking about is the
how come the other income is so fluctuating?
Because it depends on the amount of cash you have on books, right? The other income is basically your interest income that you're generating from your treasury. This year we used some of the cash to buy out some minority shareholding as well. So we had less cash on the books, so there was less interest.
Okay. And finally, I saw it in the RHP. What's this ETA Star Healthcare? I think you couldn't consolidate it. I saw it in a couple of the risk factors in some of the brokerages. Can you clarify what this is?
We had a JV with ETA at one point of time in the UAE market, since 2012 we have not actually received, and we were a minority shareholding in that JV. We were only 34%. But since 2012 we have not received either any audited statements or any information from that company, and since we are not in a position of operational control, that JV is not under our management control, and therefore we have not had any information at all to be able to consolidate at all. And in the UAE market, it's quite challenging to go and oppose this. So therefore we went to SEBI and we sought an exemption for it.
Okay. Many thanks, Ameera. You've been kind enough to come here and speak to us, and all the best for the IPO.
Thank you so much.
So that's the management of Metropolis Healthcare. The IPO opens today and it'll go on for the next 2 days.